I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Good morning, Jim, and here we are. It's Friday.
Can currency drops be like Ebola? One case, and then the next thing you know, it spreads very quickly and is quite serious.
Unfortunately, yeah. Of course, for the last month or so, there's been headlines about interest rates in Turkey going up as their currency went down. You know, that would be relative to the US dollar. And at virtually the same time, same story in Argentina with currency down and their interest rates up. And the last week and a half on the Italian interest rates have gone up. So I thought, uh-oh, and I wrote one this morning on this, and it reminds Jim of July 1st in 1997 when what was then labeled afterwards the Asian crisis started, and it was started in Thailand when their central bank ran out of US dollar reserves, and then their currency went down and their interest rates went up. And then the establishment said, oh, there's no real issue here because it can be contained. And then within a few weeks, it spread to the Philippines, same thing, their interest rates up and their currency down. And then the establishment said, oh, no, don't worry, it can be isolated. So the theory is that central bankers can prevent bad things from happening. Well, it took until September to hit New York when they, as I recall, their corporate bond market really got hit. I think it was the worst hit in about a decade. So these things have a way of their own, and even the historian in Roman times wrote as much in saying that that interest rates go up and the currency goes down, and you got troubles. So
was that Cicero? Was that Cicero who said that?
Tacitus.
Oh, Tacitus. I'm sorry.
Now, also Cicero, and listen, I'm going to show off my Latin background, Cicero, because they used the hard C. He observed that if you have a financial disturbance in the lesser countries, like that would be then in Phoenicia in the Middle East, it would spread to Rome. And so this phenomenon has been around for a long time. And then, as I say, looking at the Italian yield this morning, I thought, oh, I better write one up on it. So that's being done. And it fits with our work of earlier in the year where in the credit markets in the U.S. and we've been using the term sunshine would come into the credit markets with interest rates for low-grade stuff going down and spreads narrowing, which shows a sign of confidence. And indeed, this is happening, and we figured that it would happen. The sunshine would be really quite visible around May, and it has. So the action in the U.S. Credit markets has been very good, but then figured that after mid-year, you can get that seasonal turn and where spreads can widen, and in that there's been a big party year over the last year. You've had the huge bubble in Bitcoin stuff, and that climaxed in December, and then the senior New York stock indexes like the S&P that peaked in January. And at the moment, you can't say whether that is the ultimate high or not. It takes a further decline to determine that. But anyways, this was probable after mid-year when, on a seasonal basis, credit markets can turn and go the other way. And if you had a big party, which we have had, then often you can have a liquidity crisis in the fall. So our view now is that the markets after mid-year could turn towards adversity, and you could have a liquidity crisis later in the year. And this, watching the problem spread from Turkey and Argentina to now Italy, hey, that's what's happening. It's going along the path.
Well, the five-star movement looks like it's going to form a government in Italy, and they don't believe that Italy should have to pay its debts.
I think that many parties will, but I think the five-star party is a reform party whereby there's too much government, too much in your wallet, and too much in your face, and so it's similar to the popular uprising that's been on in the U.S. So I wish them well. Popular uprisings are interesting to watch.
We'll have more with Bob Hoye right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, it looks like crude oil has taken quite a hit today.
Yeah, it became excessive. A few days ago, we put out one pointing out that the crude market, as well as the oil stocks, the XLE, were becoming extended. And then this morning, we put out one saying that, yeah, this is it, fully extended, and then away it goes. And of course, this is tied to the firming dollar, which actually is firming. And the way that one works, we look at the DX, and we were looking at two previous bottoms, the one in 2014 and then the one in 2008. And on those ones, it became oversold. Yep, we got that in January. And then you'd want it to build a 4 or 5 month base, which it did do. And then the trick on turning the market up is to get above the 20-week exponential moving average, and that happened end of April. So we've completed a pattern that says the U.S. dollar is going to go up. Now, this is a problem, and this comes back to, like, Turkey and Argentina and any of these countries, that if they have borrowed money in the U.S., like in New York, the financial capital, and then that debt has to be serviced in U.S. dollars into New York. So all of those loans and beyond sovereign debt, and also to many corporations around the world, this then becomes a problem. And even Sir Thomas Gresham, the great trader in the 1500s, and pointed out to then Elizabeth I that when you owe money into then Antwerp, which was the financial center of the world, and you're owing it from a weak currency and have to pay it into a strong currency, it's very difficult. And so anyways, this one's been around for a long time too. So this, once the debt bubble ends, you then have the problem of servicing debt into the financial center of the world, which is New York. And that, then you can call it, Jim, a huge short position in dollars. You got to get your hands on a dollar in order to meet your obligation in New York. Now, how do you get your hands on a dollar? You sell your own currency, you sell resources, you sell things, you sell whatever. So this is how deflation in a post-bubble contraction works, is people have to meet their obligations in the financial center, and the recent events in Argentina and Turkey have been steps towards that. And as I say, this week, Italian yields going up is another such step. So it is going to be fascinating to watch.
Well, Italy is one of the biggest bond markets in the world, isn't it?
Well, yeah, they have a bond market. The U.S. bond market, of course, is huge, and that's where the liquidity is. But even in U.S. Treasuries over the last few years, there's been articles written about diminished liquidity in longer dated treasuries because there's been so many rules and regulations coming around that the banks are not positioning and trading them as they used to. So the most liquid market has become not as liquid as it used to be. And this gets us back to the fundamentals that in a troubled market, the careful money doesn't care about a return. It cares about getting money back. And the only way you get your money back is by putting it in the most liquid items. And the most liquid items are short-term instruments, treasury bills in the U.S. market. And that then puts a bid for the dollar as well, beyond just short covering or paying your obligations. People are buying treasury bills. They're buying them in U.S. dollars. So that puts a bid in for the dollar, but the other liquid item is, of course, gold. And they'll be buying gold. But if you're in U.S. dollars and buying gold, you can see that there's no big moves possible, bull market for gold in U.S. dollars. But if you're in lesser currencies, like if you were in Venezuela over the last few years and owning gold, well, the quote has gone up hugely. But then the bad guys in Venezuela, the government, might come and steal your gold, so it's a problem. So we wouldn't see making any money on the long side in gold or in silver if you're in U.S. dollars. But the investment demand for gold will increase, and that will put it up in real terms, like relative to the producer price index or the CPI. And when you've got gold going up in real terms, it reflects upon the profitability of gold miners. If their costs are kind of fixed and or in this case probable, you could have their basic costs like energy and wages and labor going down, and the price of gold staying even, and they'll make money. And that's what was the case in the early 1930s when, then Homestake was the major producer, and they didn't make so much money in the late 1920s boom because their costs were going up, but the price of gold was fixed at $20.67 an ounce. And then 2 years later, after the boom to 1929, so out to 1932, there was no change in the nominal price of gold, but everything else had fallen so far, and the energy costs and labor costs had come down. So Homestake was making money, and they did make money. For example, if you could bought Homestake in 1931 for $9 a share. And then by the end of 32, this was before Roosevelt started fooling around with the price of gold, and there was no change in the price of gold, and the stock was up something like 130%, and their earnings were up in that magnitude as well. And then Homestake stock continued up and reached a high of $65 in that level on a $9 purchase. But also in those days, the gold producers paid out most of their earnings, if not all their earnings, by way of dividend. So in the 1930s, your $9 purchase was paying you $4.50 a share of dividend each year. So the ability of gold mining to make money in a deflationary bust has been remarkable in the past. So anyways, that's ahead of us, a new bull market for gold at some time, and I'm sure we will be there when it arrives.
We'll have more with Bob Hoye right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, quantitative easing ended officially some time ago, but isn't there an unofficial form of it happening right now where all these companies are in massive share buybacks? The S&P setting a record for that last month. Do you expect that to continue?
Oh boy, that's a good question, where the central bankers may have ended quantitative easing. Yeah, I think they've been lightening up their positions, but the rise in interest rates are not due to their policy, but due to market forces. And then the major companies buying back their stock at extremely high valuations has been just plain wrong. That's absurd. I mean, and it is not going to be an easy way out of it. But they were, for a while there, the economy wasn't robust and they were not making huge earnings gains, and you had high prices, so they then borrowed money which was very cheap and bought stocks which were very high. And then that reduces the number of shares outstanding. So it's a trick that made earnings per share go up. But it's just all rinky-dink stuff. Back in the big bubble in Tokyo that ran until 1989, there was all kinds of, they called it financial engineering going on with that bubble, and the Japanese term for it was Zytec. And I guess one could say there's a lot of Zytec out there in the corporate market now, because you've had the central banks artificially making interest rates lower than they would have been. And then that allows the corporations to borrow money at very cheap rates, and then allows them, as I said, to buy stocks at very high prices. Sounds to me, Jim, like a recipe for disaster.
Haven't the heads of those companies heard buy low, sell high?
Probably, but you know, in 2007, at the height of the market, the head then of the big bank in the U.S.
J.P. Morgan?
Well, maybe it might have been Morgan. But at any rate, he said, yes, it is a party, but we are continuing to dance. And, of course, that was close to the top. And, of course, they didn't stop dancing, and they didn't get out. And there's an old saying that when you're in a financial party, you want to be dancing close close to the exit, and they didn't get out, but it ended up being quite an infamous statement of right at the top. And I'm sure that with this market, there will be some equivalent statements as well. And you've had that at the peak of the markets in 1929, where John Moody, who had started Moody's financials, he boasted that nothing could go wrong because the U.S. then had a modern and scientific central bank with the Federal Reserve. They called it the Federal Reserve because nobody wanted to call it a central bank, because there were bitter memories of previous central bank experiments in the U.S. And then if you move ahead to 2007, the market peaked in October, and everything was nervous. So in December, Greg Mankiw, who's a highly regarded professor of economics at Harvard, he got out and said effectively that nothing could go wrong. Why? Because they had a dream team of economists at the Fed. And of course it went wrong, because markets get overbought and then they get oversold. So, and there's also a seasonality to it. There's the old saying about sell in May and go away. And then there's no saying for in October, November, but oftentimes if you're going to have a contraction, if you're going to have a liquidity crisis, it will be discovered in September, October, into November. And even the great South Sea bubble, the first one in 1720, it peaked in June and then dithered around through the summer, and then became under a lot of pressure in the fall, and the stock fell from 1,000 pounds to about 120 pounds. And the market finally cleared its problems in November that year. So, yeah, there are seasonal forces that work out there, Jim.
Bob, thank you so much for chatting with us.
Well, I think we wrapped up another one here and enjoyed it, and look forward to talking again next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. You can forward questions to Bob or any of our other guests at info@HowStreet.com. And don't forget to check out our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.